Welcome to ForexTV.com. Today's Monday, August 3rd. I'm Tim Kelly with your New York Forex Market Buzz. Euro surged against its lower-yielding rivals on Monday as rising global stocks fueled risk appeal. With the gain, the European currency hit its best level since last September versus the dollar. Stocks in the U.S. and Europe surged on Monday as traders bet the global recession has reached a bottom. When stocks are strong, the euro often rises against currencies such as the dollar and yen. Slowdown in the Eurozone manufacturing activity decreased more than initially estimated in July, signaling a possible end to the recession. That, according to a survey from Market Economics on Monday morning in the European zone. The euro rallied to its highest level in more than 10 months against the dollar, reaching 144.44. The U.S. Commerce Department revealed that construction spending rose 0.3% in June. This followed a revised 0.8% slide in May. The U.S. Institute for Supply Management said in a report that its index of activity in the manufacturing sector rose to 48.9% in July from 44.8% in June. That's still signaling a contraction. Over 50 would signal expansion. The euro jumped to a 7-week high of 137.54 against the Japanese yen. With the rise, the euro rose above a near-term resistance level. Commodities jumped to a 6-month high, led by grains and metals, as signs the global recession is easing and a drop in the dollar bolstered expectations for demand. Today we're joined by Matthew Straus, Senior Currency Strategist at RBC Capital Markets. Matthew, welcome to the program.
Thank you, Jim.
Matthew, last time you and I spoke, there was a bit of a different sentiment out there, and we didn't have all this euphoria. Right now we're seeing stocks up. We've had a very positive number from ISM. I think that's probably the most important number today, although construction spending certainly played a good second fiddle to that release. We're seeing some resistance being broken here in a lot of major currencies, and we've got the commodities complex rallying as well. But what do you make of all this?
Well, I think your adjective that you're using, the euphoria we're seeing today, it looks like an euphoric rally. And at the moment, yes, the market are latching onto some of the U.S. data that was slightly better than expected, but I think also earlier today we had from the from the UK, some very strong bank earnings releases, and that really excited the market that things are not only improving in the financial sector in the US but also in the UK. And as a result, a follow-through from last week's strong ending. Equity markets, as you've already indicated, well up as risk appetite continues. Now, we think that the current rally will continue as long as the sentiment remains strong, but we're a little bit concerned that the current rally might be an overextension of what's happening on the fundamental side. Because although we see a pretty strong quarter in quarter three in the US, being a pretty strong quarter due to technical reasons, inventory rebounding, we now see on the auto sales side, the numbers that will be confirmed later today will probably show a very, very healthy bounce in auto sales, largely thanks to the government cash for clunkers program, but nonetheless, another boost for the GDP in the third quarter. So, yes, the third quarter we are less worried about, and if the third quarter was also our expectations for the quarters to follow, this might have been a sustainable rally, but we're a bit worried what will happen in Q4 and going into 2010. Not that we see the economy falling back into recession, but we just think the pace of growth will be much, much more muted and well below what we got used to after a period of a recession.
Okay, Matthew, just looking at the numbers here, a lot of this current rally, one could argue, started with earnings and was bolstered by some of the fundamental economic data. Most of the important earnings news is out of the way. Would you agree with that?
Yes. No, I think the important earnings news that we were waiting for, especially then from the financial sector in the U.S., that's out of the way. We got some major releases last week. There's still a few left this week, but I think they're going to play a much lesser role than what we've seen during the last 2 weeks. if we're looking at earnings releases, the bank earnings releases out of Europe and the UK will now be more in focus than the remainder of the releases in the US. So from that perspective, if we're just focusing on the US side, I think attention firmly returning to the data front, with probably 2 data points remaining, both of them spaced and 2 days apart. The one on Wednesday, we have the ISM non-manufacturing reading, so basically just the counterpart what we got today for the service sector. And then Friday, we're getting the all-important monthly employment job numbers. That will be very, very important. Another good reading on that front could see risk sentiment or risk appetite continuing for quite some while. And maybe just to qualify what we would consider a good number on Friday is still a negative number. I think it would be unrealistic to start expecting positive job creation at the moment, but a less negative number. The market now currently looking like a minus 325, 350,000 job losses. And that will actually be considered a decent number given the current circumstances.
Sure. I don't think there's anybody out there thinking that there'll be job growth. So I think we're pretty safe on that front, but you never know. Matthew, in terms of liquidity, just one more macro issue, and then I want to get into maybe some specific ideas on where you think this market is headed. Are you seeing any effect on this rally due to the amount of liquidity that is in the market right now? It's something we've been talking about for a while. During the summer months, a lot of participants are out. The folks I talked to said that liquidity is quite thin right now. Are you seeing the same thing? And do you think that has an effect on the sustainability of this rally?
Yeah, we looking across the markets at typical summer liquidity, which tends to be less than the other months in the year. But I would be hesitant to give that too much credence that it's just purely because of liquidity. Because if that was the case, then one would have seen some significant sell-offs as well when we had last week on Wednesday some negative news coming from China. So I think whether we had more normal liquidity or not, the trend would have probably been the same. The magnitude might have been slightly less, but I think the trend overall would have been unchanged.
Okay. Well, certainly it is a thinner market to be expected in the summer. Right now, we've got the 10-year U.S. 10-year government note up 16 basis points. Seeing a lot of gyrations there as well. In terms of credit and the yield curve, anything there that you would be watching for?
Yeah, and not necessarily this week, but the following week when we start seeing some of the auctions coming through, the longer-dated auctions from U.S. Treasury auctions. If my memory serves me right, it's a 10-year and a 30-year auction. Because last week we had 3 relatively short-dated auctions, 2, 5, and 7 years, and surprisingly, the 2 and a 5-year auctions did not go down that well, whereas the 7-year was again a strong auction. That was the last auction we had last week. So from that perspective, it's clear that despite that 7-year auction, and to look past that specific auction, there is an increasing concern about the supply of treasuries into the market to finance the whole stimulus package. And next week would then be quite telling whether the 10-year and the 30-year auctions can do well. If not, then we can expect some further sell-off, and I think that is what the market is expecting. That those auctions will not go down too well, and we could see the yield curve ticking up even further. Okay.
So Matthew, let's go in the time remaining. Looking at the majors, beginning with euro dollar. It seems that from a technical perspective, euro dollar still has a looking pretty bullish on a technical basis.
Also today, extremely bullish on a technical side, because there was a very strong resistance level at 142.33. That the market was trying to test for the last 2 weeks, and they couldn't really break above that. Some intraday moves above it, but they couldn't close higher than that. and it became a very, very important key resistance. And now today it broke through that and continued racing, and currently trading above the 144 mark. So from a technical perspective, yes, there is definitely some further scope for a euro-dollar to rally.
Now, sterling is reaching almost dizzying heights now. As fast as it was dropping, it is now rising again. Same situation there, Matthew?
Same situation. One probably has to also look at sterling as the proxy for financial sector health globally, and that's when sterling really got hammered during the period when the market was doubting whether some of the huge financial institutions will survive this crisis.
Right.
Vice versa, with that uncertainty now basically being removed and the banking sector coming in with quarterly earnings that is actually surprising to the upside, sterling is one of the big beneficiaries. So from a fundamental perspective and in a short-term technical perspective, breaking some important levels as it is on its way to 170. The one concern here would be from just a daily valuations studies a bit overboard, but I would not suggest that one stands in front of the trend at the moment.
Right. Okay. Just moving right along. Let's make a stop up in your neck of the woods. Dollar Canada. Canadian dollar, obviously on the commodities increase, the energy complex rising the way it has. Right now, Canada's enjoying a good run.
Absolutely. Canada, together with the other commodity currencies, are clearly benefiting from this increased risk appetite. And with oil now pushing above $70 a barrel and quickly closing in on that $73 that we saw in the end of June this year, which was the high for the year. Things are looking quite upbeat for the Canadian dollar. Now, I think the Canadian dollar strength can continue as long as global risk sentiment holds. Those two at the moment are very much intertwined. So if we see a faltering sentiment for whatever reason, that will stall the rally in the Canadian dollar. But for the time being, yes, things do look quite upbeat.
So in the next 2 weeks, Matthew, just to close here, biggest event risk right now has got to be the monthly jobs report, non-farm payrolls.
Yes, for the next 2 weeks, I would definitely highlight that as the biggest risk. Okay. And then for the bond markets, following that, also the auctions.
The 10 and the 30-year auction.
Yeah.
Okay. Matthew, thank you so much for your insight. Always a pleasure to have you. We really appreciate you taking some time out of your day to join us here.
As always, you're most welcome.
Thank you, Matthew. That was Matthew Straus of RBC Capital Markets. I'm Tim Kelly. Join us later this afternoon for PM Exchange right here on ForexTV.com.